Hello class, welcome to this handout one answer video. All right, so hopefully you've had a chance to go through handout one. Done the answers on your own, and we'll kind of run through them now. Let me get the handout pulled up here, share my screen. We'll go ahead and get started. All right, so first here, we got three questions here that are dealing with our principles, our fundamental characteristics, our enhancing qualities, and then the assumptions and the principles. First, we got four statements given below. Give the qualitative characteristic or constraint that is most applicable to each of these statements. So a financial item that may be useful to investors is not required to be reported because the cost of measuring and reporting this information is judged to be too great. That is the cost constraint or the cost benefit analysis. Okay, in that case, we do not need to report something if the cost to report it is going to outweigh the benefit. All of these qualitative characteristics hinge on that one thing. Okay. B, timely information that is used to predict future events or provide feedback about prior events is said to possess this characteristic. In this case, that means it is relevant. So that is relevance because it has predictive and confirmatory value. Okay, because we can predict future events or feedback about prior events, so we're predicting and confirming. That is part of that fundamental quality that makes accounting information relevant. Quality of information that enables an analysis to evaluate the financial performance between two different companies in the same industry. That is comparability. Okay, it can be used within one company, making sure we're being consistent, but also you want to be consistent within the industry, doing the same thing that your competitors do. So that way, when you look at most statements, you can see which one is outperforming the other. Finally, a trash can that is purchased for $10 is expense, even though it should be recorded as an asset because it'll be used for many years. But $10 trash can is not very important in the grand scheme of things, whether they expense it or whether they capitalize it and expense it over its useful life. What you're going to do with assets, that small amount, that is materiality. Okay, is going to be immaterial to someone that's looking to invest in the company, how you actually recorded that $10 trash can, because in the grand scheme of things, it's not that important to the business. All right, so now we're going to move on. We're going to talk about some assumptions. The Peter Schmidt Company values its inventory reporting the financial statements in terms of dollars instead of units. So basically saying it's reporting what its value is, not how many they actually have, not the exact number. That is the monetary unit assumption. Okay, where we only record things in their dollar amounts, not based on the actual quantity. So this heating company, and number two, or B here, prepares financial statements that make sure the purchase of a new truck for personal use is not included in the financial statements. That is the economic entity assumption. Remember, what is personal use needs to be kept separate from the business. The separate is its own economic entity. We do not want to record personal purchases in the same thing with the business. All right. Property, plant, and equipment, or PPE, is recorded at cost minus any accumulated instead of liquidation value. Liquidation value means is what they can sell it for right now, or its fair market value. This is the historical cost assumption. And we're always going to report stuff at what it originally cost, minus any accumulated depreciation. We're not going to worry about what it's actually worth today. And the final one here, Mueller Inc. prepares quarterly and annual financial statements. This is our time period assumption that we can break down the activity of a business into smaller time frames. So now move on, we're going to talk about some principles. Right, so being able to identify principles. Quagmire Company recognizes revenue when the goods are delivered to a customer, even though cash will not be collected from the customer for 30 days. That is revenue recognition. Okay, we recognize revenue, we record the revenue when the goods are delivered or the services are performed, no matter when the payment comes. That is the point of the revenue recognition principle. Inventory, which was recently damaged by a flood, is reported at the lower of its cost or market value. This represents conservatism. Okay, because inventory now is damaged, it's not going to be worth as much. So we need to recognize that expense or take away that loss of value as soon as it happens, as soon as we know it. That is the point of conservatism. Remember, is to delay revenues as long as possible, but as soon as you know something has lost value, you want to get that loss on the books as soon as possible. I see. Moslink recorded land purchased at $50,000. In future periods when the value of the land is increased, the land is still reflected at $50,000. And this is historical cost. You're always going to keep stuff recorded at its original cost, even if it goes up in value. There's kind of conservatism there too. But the main principle of this one is this historical cost, and it's always at its original cost is what we keep it recorded as. All right, the cost paid for a delivery truck is recorded as an asset and expensed over the next 5 years as it has helped to generate revenue. This is the expense recognition principle. So when we make this initial purchase of the truck, we don't want to create an expense in that period where we actually pay all the cash, because the expense rate says we have to expense it as it generates revenue. A truck is used for 5 years, so we need to spread out that cost and expense it over the whole 5 years as the truck is being used. All right. Company accepts $200 in December for services to be performed in January. The company recognizes revenue when the services are performed. This is again a revenue recognition principle. When they actually receive the cash in December, they would not record the revenue because they have not performed any services or delivered any goods. Instead, this is where you get that account unearned revenue, which is a liability, which must be, means we have an obligation to perform these services later. And then when we actually do the services, then we can move it out of unearned revenue into our regular revenue. And finally, Mac Company purchases supplies March, however, does not expense supplies until they are used. Again, that is the expense recognition principle. Even though we bought them in March, they did not generate any revenue, so we actually pay the cash for them. We're not going to create an expense at that time. We're going to expense them as soon as they get used up, and when they're used up, they are generating revenue. Okay. A lot of it is, some of these is revenue recognition and the expense recognition are adjusting entries, which we're going to get more into when we get into chapter 3. It's important to know how all of these policies are used. So hopefully this will help you out, help you some practical use, some practical examples of how these assumptions stuff are used. Number 4 here, we are analyzing some transactions like we finished up in the chapter 1 lecture video, or chapter 2 lecture video 1. Okay, we just need to identify what is happening in these equations and making sure our accounting equation stays in balance. So first we borrow $50,000 by signing a note payable. Well, $50,000 is cash, so we're going to have cash, which is an asset, goes up, and we have a liability because we have a note payable now. It also goes up. Okay, so that's how we would keep in balance. And remember, our assets always have to equal liabilities plus equity. That's what we're doing here. We're analyzing to see what's happening and how it is affecting that accounting equation. Next one, we purchased $25,000 worth of equipment for cash. Okay, well here we have an asset increasing, the PP&E, okay, which is the equipment, but we also have an asset decreasing, which is cash, right there, okay? And then our left side of the equation is staying balanced there. We increase an asset and we lowered an asset. Paid $500 landlord for rent in January. On this one, we have an asset going down, which is cash. And we also have a decrease in equity because we had an expense. Remember, in the expanded accounting equation, net income goes into retained earnings, which is part of equity. So revenues are going to raise equity while expenses are going to lower equity. Next, we perform services on account for $10,000. One of the key words here is on account. So we have an increase in an asset. And that asset is going to be an accounts receivable. It was on account. We did not receive the cash yet, but we are owed that in the future. And it's going to move across. We perform services. So we're going to increase our equity because when services are performed, the value of those services are known as revenue. So we would actually be increasing our revenue at this point. E, we collect $3,000 from customers per services performed in transaction. So now we are collecting the money. We're going to have an increase of an asset, cash, because we received the money, but we are also going to have a decrease of an asset, the accounts receivable, because we are no longer owed that money. Okay, notice that we collected the money here, but we didn't do anything with the revenue at this point because all of the revenue had been recorded when we actually performed the services. Going back to our principles there, that is the revenue recognition principle. So we record all the revenue as soon as the services are performed, regardless of when the cash is received. F, we paid salaries for $250 for the current month. Well, here we have a decrease in an asset, cash. We also have a decrease in equity because we paid salaries. That is an expense. That is the normal course of doing business. To pay salaries and wages, and expenses lower equity through that retained earnings account. In G, we declared and paid $800 dividends to stockholders. Well, here we have a decrease in assets. The asset that is decreasing again is cash because we paid it. We also have a decrease in equity because of dividends. Okay, remember dividends, lower retained earnings. Retained earnings is one of those components in equity. And finally, we purchased $2,100 worth of supplies on credit. We have an increase of an asset. In this case, our supplies went up, but we did not pay them cash. Instead, it's on credit. So that means we have an increase in a liability because we now owe money. And that would probably be in an accounts payable. Okay. So this is the first thing we're going to do as we move along in this chapter. Okay. We need to remember our principles and our assumptions and our qualitative characteristics as we start doing this and we start thinking about it. We're always going to need to analyze a transaction like this. This is called analyzing the transaction. And you're going to find out now, we're going to get into actually recording them. And once you have it analyzed and you know what is actually happening here, what's going up, what's going down, then we can go through and start recording it and start making journal entries, ledger entries, and making a trial balance, which I will discuss in chapter 2, lecture video 2. And I will talk to you again soon.